Today we're going to talk about the importance of focusing on the numbers. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Hopefully everybody's had a good start to the trading week. Obviously we've had quite a bit of volatility on Monday. Yesterday a little bit of volatility with the interest rate cuts from the US and Australia. Today we're going to just progress in our conversation with focusing on the numbers and the importance of how those number levels can remove a lot of the illusion that the price action on the charts with candles, bars, lines, whatever you're using may add a lot of confusion or distraction. Now, we talk about using the high and the low of the week, the day of Asia. We talk about focusing around that 12 candle window around the equity opening times and the importance of that. We talk about the importance of double zeros and the 25 pip increments and the price action or the candle confirmations around those levels. When the pattern presents for a sell high or a buy low, or even in the trending market, if the market breaks out and pulls back, we're still buying low inside of a number box. Today we're just going to go through some examples after on the charts as well in terms of the importance of focusing on the numbers and what you can do each day to prepare to identify hopefully some of the higher probability or higher possibility setups. Now obviously each day when we come in, regardless of the instrument that you follow, in my case and in some of your cases, obviously we're focusing on the British pound crosses. The market can trade all over the place. It can have come from up top or from down below. We could have all the indicators lining us up for a trend in one direction. But by the time they go through Asia, in a lot of cases, those technicals can be a waste of time, or they may drag you into one side, triggering a lot of the technicals. But at the end of the day, what we want to try and identify as we come to the end of that session is the market trading off of specific numbers. And often in many cases, the market may have come down from up top, as we saw the last few days, and pulls back up and starts working within a range. But there's a couple of things you want to start to look for. Number one, especially we're going to go through some examples today, is the market dropping down from where it's trended from. If it's dropped down, for example, the previous day, have they shifted their supply box down a level? Have they shifted it down 25 or 50 pips? Are we in a 50 pip box? Are we in a 25 pip box? And in some cases with the pound New Zealand, pound Australian, maybe we're in a 100 pip or more box. But you want to start to identify if they're dropping it down, the sell, in this particular case, the sell levels. Have the sell levels dropped down? Well, even though we've had the market come off of a low, they're selling lower into the session than they were at the beginning of the session. So although our high of the day is up here, when we get to the end of the Asian session, our redrawn high of the day is in here, and they have at this point shifted their supply box or their selling levels down. Even though they jam traders into the middle around a median price, which is where we don't want to get caught, their supply box is dropping down and they're selling from that lower level rather than up here. Now, as the session progresses and we come to the end of Asia and we're looking for that Europe breakout either up high or working back down towards the low, the next question we want to ask ourselves is, when we get to the end, have they come outside of that range? Have they gone up through here, or have they gone back down? And if they've come back up here, what time do they get here, and where does London open? So when we get to the London Open, if we're up top, even though we've gone up there, we're still in a selling area. Have they come up to the numbers? You'll find that 99% of the time, these markets will trade off of numbers, and you already have seen that. I've received a ton of emails. In a lot of cases, if you identify that number level, for example, if this is double zeros, and this is 50. This is a 50 pip box. Now, if the market trades up into that box in London to the quarter level, the question then becomes, if it's a sell high setup, is are we selling above this box for the move down, or are they selling back to the top of this 50 pip box for a move up? Now, again, we look at two things with the highs and lows. We know that there's money and stops below and above there. So if the market has triggered stops on the upside, or if it's taken out the high or jammed into a high, often you'll see they'll trade into a peak but not through it, because they're trapping traders up high. They're jamming them in, getting them to chase the move out of the range before they reverse it quickly to go and hit the stops on the opposite side. Most importantly though, what we're talking about today is identifying the box itself that you're trading in, trying to ignore perhaps a lot of the movement and ask yourself the question, what's the high number, what's the low number, and if there is a median number, what is it? So, for example, in the British pound, you might only be in a 50 pip box, but the median price level might be a quarter level. Whereas with the pound Australian, the pound New Zealand, you might be in a 100 pip box, and your median price might be a 50 level. But what we're looking for is evidence of where the buying low is and where the selling high is, and then identifying those number levels for potential strike zones when the market opens. When the Asia close, Europe open happens, are we up high in the box? Are we up high here somewhere for a sell? Unless, of course, we've got evidence that we're in an up template and we're looking for possibly a second day trade with a trend. Trend trades will typically take out the previous day's high or low and layer on top of or just along that high before they continue the move. They do not burst out. If Europe is just breaking out, it will typically go out in 3 bursts before returning right away back inside of that box. Again, identifying our numbers of where our potential trade entries are going to happen. And again, specifically at that 12 candle window. So, preparing for each day. What are the numbers at the high, low, and the median price? So for each pair, I'll typically I have the 6 pairs on my charts. Immediately, just visually, I can see if a pair is trading within a number range. If it's around a number range, again with the pound Australian, the pound New Zealand, is it around double zeros? Is it sitting in the middle somewhere? If it's just trading somewhere in here, I want to wait until it gets to numbers on either side to then go back and look at what type of price action are we having. Have they done a stop hunt? Is this a breakout? What is it? Have they been moving down lower from the previous session or moving up? What we want to know again is, are they dropping a supply box down in 50, 25, 50 pip increments, or are they moving it up from the previous session? What you'll often find when we get to that level 3 is that if they've been dropping down supply boxes during the US session or the next Asian session, all of a sudden they'll be layered on top of one of these boxes, working it from the other side, and that last supply box will be underneath of that range. And we'll go through a few examples of that today. At the end of Asia, are we up high or down low in this range? At the end of Asia, are we up here somewhere or are we down here somewhere? And when Europe transitions happens, does it continue to work the low, or does it shoot up towards the high and stop hunt the high of the day? Again, we're looking for evidence. We want the smart money to show us what they're doing. We're not looking to try and jump on a move right away. We're looking for them to tell us what they're doing, at what price level, and which direction they're looking to shift the market. Now, you have to think in simple terms. There's a couple of things that they can't hide. One, is the time that they go to work. So people, you know, they run algorithms, they have institutional traders usually in 3 regions around the world: Asia, London, New York. But think about where a lot of that volume comes from that they benefit and make money from. We're going to talk about that in one of the future videos about Goldman Sachs, 10K filings. They have losing days, but the number of winning days that they have. Think about what we're trying to do. We're trying to piggyback on their trades. We're not trying to predict or interpret what they're throwing at us. This is all an illusion. Focus on the numbers. They can't hide their footprints. That's what you need to understand. They cannot hide what they're doing. It shows up in the price, at the numbers. So we want to know what levels are we seeing the trading occur. Can we identify a box? Are they shifting supply levels or moving demand levels up or down? Is it a sell high or a buy low day? Now again, just going back, you know, we want to be aware, is there any news on the calendar? And again, we talked about this. News is often an opportunity for them to trap traders into the middle of this range and then spike out one side or the other, or both in some cases, like the BOE, payrolls, Fed. You know, they had an interest rate cuts yesterday. We saw some spikes, 50 pip spikes on a couple of those candles. Be prepared each day, even if you're just focusing on 1 or 2 pairs. What are the numbers at the high, low, and is there a median price? Are you in a 50 pip box, a 100 pip box, a 25 pip box? Have they been shifting down lower highs, jamming traders in, or moving it up from the previous sessions in terms of where the selling or buying has been occurring from? At the end of Asia, are we up high or down low in that range? When they come out of Europe, are they breaking out of that range, or are they working aggressively to the other side? In a stop hunts are aggressive and fast. Breakouts, trend continuations tend to be creeping trends. If you get a creeping trend in Asia, where the market just keeps creeping on itself, eventually it will capitulate in either an aggressive move out of that range or a stop hunt in the other direction. Same thing. Are there any profitable trades in Asia? Again, just reviewing. If somebody's in a profitable trade from buying low or selling high in Asia at the high or the low or somewhere in that range, at some point, the majority of the time, the market will go back and either stop them out at break even or run their stops above or below the range, which is where the bulk of more of the money is sitting. We talked about this in one of the earlier videos. Where is the money? So, in your head, you can do the math often. If there's a profitable trade in place, how many pips away am I from that? Am I at numbers? Is the market giving me a sell high opportunity or a buy low opportunity if there was a profitable trade up there? Because nobody gets a free lunch. They will go back, and you know, if you've been in trades, you've been up 25, 50 pips, you go to break even or you trail the stop, they will come back and get you. When London opens, are we outside of the range? Are we up high or down low, or are we inside? We talked about this, level 1, level 3. If you're up high after a 3-day cycle, is London opening up in a very tight consolidation? We could be in a potential for a big move in the opposite direction. Or are we jammed in heading into the news? BOE will often see this. Sometimes they'll consolidate the range, or in payrolls, they'll consolidate a range. That consolidation builds a lot of orders up inside of that range that can be stopped out on both sides. But again, just being prepared each day. What number levels are we at? If you think about it, if you can sit there calmly at the screen, knowing that you're going to be able to enter in near or at the numbers based on what the market tells us. What are they doing? Are they bringing the market up to sell it off at a price level? Are they bringing it up high and pulling back to continue that move off of a price level? So again, we talk about these boxes. Think of these 00 50 pip boxes as actually that, a box. Are they coming inside of a box to buy off the bottom of that box to take it up another 50 pips? Or are they coming into double zeros and selling it at the numbers or below the numbers with pins to drive it down another 50 or 100 pips in the opposite direction. Later on in future videos we'll talk about smaller time frames, but today the important thing is, again, just sticking with the simple system. You can't hide the high and the low. We know what the 12 candle window is for us for the most opportune times. We know that the institutions work off of numbers. Computers, institutions, private traders, the moves come off of numbers. And then looking for that confirmation through our price action of where we can enter the trade with a tight stop for maybe 3, 4, 5, and in some cases 10 to 1 return on our trades. Now we're going to look at some examples on the charts. We'll be right back.
Okay, traders, let's go through a few examples now. Today we're talking about focusing on the numbers, how the price action sometimes can be a distraction or an illusion. The smart money will paint a picture for us, trying to deceive us, and meanwhile they have the opposite in mind. So each day I come to the screen, I want to know, we want to be looking at the Asian range. So, the market is always trading off of numbers. People argue about things. They argue about technical analysis. They argue what's a trend. They argue what's, an entry point, all these things. When we talk about 4 simple things, we talk about the high, the low. We talk about the equity opening times. We got Asia, London, New York. We talk about using a 12 candle window to look for the highest opportune entries, and we talk about using numbers, specifically double zeros and 50s. And in this particular case, if we'll go through a few different examples this week, we see that the market has traded essentially off the numbers between 25 and almost up to the double zeros. But we know that essentially we're inside of a 100 pip box. If we cut this Asian range into the second half, because it's split the box and we're in the upper half of that 50 pip box, essentially you could say that this is the 50 pip box that we're in. And we'll just change that. If we look at that, what we want to be able to do is say, okay, we're looking at 50, 75, and double zeros. The market, in this particular case, this is a high of the week formation. We'll talk about these later. You'll see this pattern over and over again. The market has moved up 3 levels, 25, 50, 75 pips before giving us a peak candle, which is taking out a session high from the previous close on Friday, and then pulled back in. But importantly, so in this particular case, it obviously didn't get up to the double zeros, but we had a peak formation, and traders were able to, at the numbers, if they didn't want to short it up higher, was sell at the numbers at 75. Okay, and again, we talked about measured targets yesterday. I'll often use 2 times that range. Somebody asked me yesterday if these are fib levels. No, they're just 100% expansions of the trade box that we're in. The other option is to use the number boxes. So if it's a 25 pip box that you're trading in, you can go for a minimum of 50 pips, which took us back to the low of the day. And obviously this market continued to do a measured move as it was in a 100 pip box in a downtrend. And we talked about, is the market trading off of the lows inside of a box, or is it breaking through into the next box and selling high? And these are some things you want to consider when you focus on the numbers. A candle that comes inside of a box at the top may be at the low of a session, but you're actually selling up high in a 100 pip box. That market may only go down to 50 as it did in this case, which continued down. But point being, you're selling at the top of a 100 pip box at the right time. So again, just coming into the next day, yesterday, we come into the session as we head towards the end of Asia. The market at the Asian close broke higher. We could therefore say our market was trading inside of a 50 pip box, and in this particular case, the 50s was the median price level. And again, a bit of preparation showed you that that upper quadrant, that 75 area, was where a peak formation was from the US session. The market went up to the top of that range, gave a sell high signal off of numbers for a move back down to the redrawn low of the day. Now again, that may not have been a trade that most people took. We'll talk about smaller time frames later. The concept I want you to grasp out of this is the numbers that were present where the range was trading around and the median price. Now, one thing I want to point out on this particular pair today, the pound Swiss, is that if 75 was our upper boundary from yesterday, as the market was moving down, we started with our 50 pip box on Monday. The market dropped down 50, dropped down another 50. You'll notice that it was selling in that upper 50 pip box. Then it came through at the end of Asia, and if we kept sliding that sideways, you see they're making higher highs, and our demand box that was down low is potentially now shifting underneath of that 50. Time will tell today if the market comes back down inside of that 50 pip box to retest yesterday's lows, or if they protect that 50 level for a possible move back up towards Monday's breakout traders. So just a concept again, as they lower down their supply box, at any point have we seen that possibly shift where the demand level from below has shifted up, so where we're getting the buying now moving up possibly in 50 pip increments as well. So if we look at the pound Australian, same thing. We had Monday's range. Again, as we headed into the close of Asia, we had basically a 100 pip box. The market shifted down 25 pips into the open of Europe. We can redraw the low as well. The market drove down, and again, you can see our supply levels for selling have dropped down as well. The market was selling off the top of that 00 box up high, was still making new lows, and then yesterday, after they sold lower, 25 pips lower, and shifted it down, the selling shifted down another 50 pips. We'll move that up actually. So this selling box has now shifted down to here, and when we redraw our box yesterday, you can see that our 50 pip box is inside of a possible peak formation as they've sold down and came back to the numbers again. So for both of these days, again, just focusing on the numbers, the market has come back off of 00s through the 50 up to 75 and gone sideways and then rolled over at the numbers. So the market has painted us a picture. You can see the M formation, but more importantly, you can see that we're dropping down number levels when we get this price confirming and rolling over. Whether you get it at 75 or 50, it doesn't really matter. You're trading in the right direction. They're going to retest the low of the day. Yesterday, we saw the market creep up, shoot straight up to the 00s, 1 push, 2 push, 3 pushes, and a pin, a big pin, almost a 50 pip pin, before dropping down and then doing the same thing back up, 3 pushes back up into 50, dropping down, hitting it once, twice before shifting away. And again, we talked about paying attention to watching the market drop down its supply boxes before the market then shifted down vertically. And if we had a supply box up top here, you can see the market is now traded through that. And again, today we'll look for if there's a retest down into this lower 50 pip box, or if the market may find support around 75 and 00s for a move back towards the high of the day. The pound yen, again on Monday, if we came to the screen, if we drew our 50 pip box at that last half of Asia, 00s and 50s, the market gave us our pin for the sell high setup. It then consolidated underneath of that range. We dropped that down. The market came down another 50 before pulling back 25 and then selling off towards the low of the day and the low of the week. consolidating and stop hunting one more time into the US Open before reversing. And again, now we see that supply box has been cleaned out. We possibly have a demand box underneath. Yesterday, that market, again, redraw our highs and lows heading into Asia. We're inside of a box, but now in this particular case, the market, we'll redraw this, has shifted down 25 pips from the previous selling area. Stop hunted the low of the day, so now our supply box potentially is still moving lower, and our demand box underneath of that 50 level will hold, and unfortunately it didn't. They traded right through that, lowering their supply box down, and our numbers again being double zeros between 100 pip box. So the concept, most importantly, as we get to the end of Asia, is where did buying occur? Where did selling occur? We might have started up here, but when London opened up and came back in, we now had a 75 and 25 as potential areas for buying and selling. The market made lower highs before breaking out, no trading in the middle. But once it broke that level, you can see how the move back to the double zeros became an opportunity for traders to short, or if they'd waited till later in the session, the stop hunt on the low of the day offered possibly a return trade back into the 50 pip numbers from zeros. If we look at the pound, again, high and low, where is our box at the end of Asia? In this particular case, we're looking at a 25 pip box, which is reasonably normal for the pound in terms of our upper buying and selling. The market came down off of the 50 level, again off of numbers right at the Europe Open, came straight down right through the lower box. Importantly, our number levels gave us the information for possibly a sell high day, back in line with the original drive on Friday, back towards the lows of Friday, which was a stop hunt on the person who went long on the pin bar. Then yesterday's range, same thing. We identify our numbers at the end of Asia. We have double zeros and 75. The market gave us pins up high for a sell off the numbers, came back down, did not quite go to the low of the day or to 50, went sideways under 75, which they again came long off of to hit the high of the day. Traders were shorting. Again, here's an example of a market breaking out, pulling back and going into a range-bound market, and eventually gave a buy off of the 75 level at the lower part of the box, back through the high for a 50 pip move up. Pins on the bottom, pins on the bottom, pins on the top, but we were making new highs, and when the market came long the third time, it broke through finally to the upper level. So again, we see that initial demand box that had been dropping down potentially now has shifted, and we're getting a buy box underneath, somewhere underneath of the double zeros, for possibly a move back long. Time will tell. So hopefully you're getting the concept, traders. We want to just be identifying our number levels. They can't hide where they're trading from. So regardless of where you draw them, we want to know where have they been selling, where have they been buying. If it's double zeros, look to enter in at the double zeros. If it's at a quarter level, look to enter in at a quarter level. If the market doesn't give you a chance to get in at that price because it pulls away, do you have candle confirmation at the lower or upper level for a trade back into that move in the opposite direction or with the trend? Really important though, highs and lows, that's where the orders are. The numbers are where we're looking to enter the trades, and they can't hide that from you. So step back, have a look at where they're establishing the Asian range, try to identify the highest probability areas for your thesis for selling high or buying low, and when the market opens in that 12 candle window, look for candle confirmation to enter your trade, have a 1 bar stop, and 50, 75, 100 pip target for 3, 4, 5 times your risk. Hopefully you got some value out of today's video, traders. Focus on the numbers, keep it simple, keep getting better, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.